welcome to, I guess, what is the kind of Binary Capital podcast series. You're lucky to know you're the first, hopefully, of many
Thank you.
in our series. So it's a pleasure having you, Manish. I've known you a long time. So thank you for spending some time with us. If I may, maybe I'll give you a little bit of background on myself. Binary Capital, Saftar Sarwar, I'm the kind of CIO. I've been with the business since inception, last 7 years or so. MD, so been managing the growth of the business in terms of investment management, portfolio management. What we do is we face into IFAs across the UK in different strategies, low cost, balanced portfolios, as well as maybe some more aggressive portfolios, which we call adventurous portfolios, all across the UK, fully FCA regulated advisors, and we've been doing that for many years now. Luckily, at this stage now, we've managed to scale significantly, strong AUM. We'll touch on it in due course, a very, very good performance as well. And what I want to do now, Manish, for the next 30, 40, 45 minutes, is to have a discussion, a debate around what we're doing, what you're seeing in markets, economically as well. So be as open, as free, as provocative as you want to be. I know you've got some really strong views.
You know my views, yeah.
Yeah, so I welcome that. We welcome that, as I do, as I have very strong views, and our team do as well, because we want to, fundamentally, we want to educate ourselves and also inform and educate the wider public, listeners, prospects, our clients, and so on as well. So we've always wanted to do this, so it's great to have some time with you, Manish, to do so. So if I may, perhaps you want to just give us a bit of a background on yourself,
Sure.
What you do as a CIO of Crossbridge Capital, and so on as well. Thank you.
Thank you, Saftar, for having me here in this studio in London Bridge. So my background, I started my career in banking at UBS Investment Bank. I was doing fixed income, securitization to be precise. So I saw the 2008 global financial crisis. Then I was at SocGen doing equity research and portfolio management, more on the equity side, European equities. And I have been at my current place since 2011, so my longest. And all we do is equities.
Okay.
So that's our main strategy.
Not fixed income?
Little fixed income, so it will be more buy and hold, but we are not going to take a strong view or directional views on credit. I mean, you can't be an equity guy and not have a macro view, because then you're not doing your job. So
sure.
Yes, we do have to express our views on rates and FX and everything, but largely we express our trades through large cap stocks. And in that, I use structured trades. So I'm going to structure trades on basket of stocks, basket of indices. The idea is to make money in a flat to negative market. So what we call ourselves absolute return.
Yeah.
But our idea is to make money even in a flat to negative market.
And who would be your typical clients, Manish? Who would be your typical clients in the business?
So our clients are still private clients, and we've had them for a long time now, since the firm was set up in 2008. They do share same investment philosophy as me, in the sense that they want to take long-term views. I like to say that I bring the private equity mindset to equity investing. So all our trades are 3 to 5 year. In a busy month, I'm doing 2 trades or 3 trades, not more than that. So
in any one month?
Yeah, in any month.
Okay.
So we don't believe in just, I don't believe in timing the market. I think you just get lucky.
Yeah.
People remember the gains, they forget the losses, and they think that they're genius.
Indeed.
So I think that you cannot beat the cycle, but you have to trade along the cycle. But if you take a medium-term view, then you can really mitigate a lot of short-term risks. We saw that stuff, with Trump. On some weekend, if you slept from Friday to Sunday, nothing happened.
Yeah.
But if you are awake 48 hours, everything happened.
True.
So if you the more you look at news, the more you get confused, and human mind is just not adept at making so many investment decisions so quickly.
Yeah.
So that's my thesis on, I can do all the maths, but I think that you still have to have a medium to long-term view when you're investing.
And that's that thesis you've held at Crossbridge Capital since you've been there.
Absolutely,
as a CIO.
yeah. I've been doing structured trade for the last 17 years. I started doing at SocGen. We've done at Crossbridge since I've been there 14 years. Yeah. And our returns have been 12% per annum without leverage, net of fees on large cap stock, consistent large cap stocks. And I like to say our goal is to make around 12% per annum on a 3 to 5 year cycle.
Give me an example of a trade, for example, some trade you've got on, so we can get a sense of it in reality.
So I would express my trades in basket of stocks on a theme. So let's say we did something on industrial. I'll have 4 stocks, 4 large cap industry. And I keep saying large cap because I don't like to take mid and small cap risk.
Okay.
Because mid and small cap risk just does not work for my structure. What I'm essentially taking a risk on is the company not going bankrupt and company having stable income and growth. Because I am creating an income structure which is going to perform even in flat market. So if I told you that S&P 500 is going to be flat next 5 years, how do you make money?
Yeah.
Either you trade in and out with every fall and rise of the market, or you do what I do and we create a 10% return or 11% return per annum and you get paid on it. So that's my thinking, that you cannot, I think with best of my data and knowledge, I can't predict a recession. I can't predict a COVID. I can't predict any tariff tantrum from President Trump or anyone else.
Yeah.
But I have an edge in knowing my stocks, where earnings are going to rise in line with nominal. Remember, we live in nominal world. We don't live in real world. Inflation is not 2%. It's much higher. If you went and bought that sandwich and M&S last year and you bought today, you know where inflation is. It's not 2%. It's at 10% or 8%. So it's all nominal. And equities are the best way to express nominal increase in wealth. If you're sitting in cash, you don't own asset, you don't own equity, you're losing out because your real earnings may increase, but in nominal terms, you're falling behind.
Yeah.
And this is my thesis, to be invested in equities and be an asset owner in this world.
As an example of an equity position you've got just now as part of that basket?
So I would, as I said, we do basket trades. So we have industrials, we have financials, we have technology. So I will never have a single one stock trade.
Okay.
So I would always have a basket. So even in semiconductor, I will have a basket of AMD, NVDA, Qualcomm, and TSMC, these names. The reason I say that, I'll give me a very specific example why I use this strategy. If you cast your mind back to October 2021, when everyone was going gung-ho about semiconductor stocks, and you could do all your thesis, and NVIDIA is going to go up and tech is going to do, and look what happened in 2022. NASDAQ fell by 33%.
That's right.
Imagine you put a trade in October with all these 4 semiconductor stocks. You're sitting there, you've done your research, you're smug about it, everything is going very well, and then suddenly you start seeing your stock going down. It's easy, with benefit of hindsight, that you could have traded that and you saw anything coming. But when you are owning a single stock position without any hedge, and when you see your stock go down 20%, you start getting a bit nervous. But you think, well, this is a stock I have done research on, I'm going to continue to hold. It goes another 10, you really start feeling anxious about it. It goes down another 10, you're down 40%. There are very few people who will ride that cycle without any protection. And that is the wrong time to buy protection, because protection costs have increased tremendously in that market.
Of course.
So, and I have a trade on, the reason I'm mentioning that because I did a trade on this in October, not to prove anything to anyone, but it just happened to be the timing wise. And then the stock started falling down. But for me, the risk happens at the end of my trade, at the end of 5 years. So drawdown doesn't bother me because I have protections on the downside. So I could sleep well. So that trade I held on for 2.5 years, and I made 14.5% per annum, 131 wherever it matured. If I didn't have that protection, I would probably have thought about selling it out and making too many decisions, and I would have been wrong in that.
And you will then take counterparty risk from an investment bank who will give you that protection.
So I'll have I'll have it in note form.
In a note form.
All what I do is basically I create a payoff. I create a payoff. I take a view on how my payoff should be, what my risk should be. And so it's a curated note, where I define the payoff. That my risk is that at the end of 5 years, one of my stock is not going to be down by more than 40%. That's the risk I'm expressing. It's a fully funded trade, so I put it on deposit.
Got it.
I get the deposit, I get the dividend, I get it. And then I create conditions in my note, pre-specified, not after trade, which says that if this was to happen in 6 months' time, i.e. if all the stocks were positive, I get my coupon paid and I'm done. If not, then go to next year. So there are 3 or 4 structures that I do, which I have done for a long time.
And I guess this must be very popular. Clearly, you've got a lot of clients that you're.
We have done that, and we continue to do that because, as I said, I spend most of my time reading, understanding my stocks and the market direction.
I'm going to come into that.
Market direction.
I want to explore something, Manish, around what you've just said about market timing, drawdowns, stress around a drawdown and whatever. In terms of what we do, I want to get your view on this as an informed participant. So what we do at Binary Capital is something quite different. Going back to that example on October 2021 or even 2022, as you know, the way we manage money is obviously a lot of it money through fund structures, buy X fund, Y fund. You know, as you know, there's so many fund choices out there. And what we tend to do is this. Say, for example, a balanced mandate. Say we have a basket of 10 or 12 funds, okay? We invest in those funds. We invest for the client in a high conviction manner, clearly, as opposed to 20 funds and 10% positions, 8% positions per fund. And what we do is, as you say, we don't also believe in market timing. We think it's very hard. You might gain something 1 month or 1 quarter, then subsequently lose by you timing in and out. You're costing clients money and cost. But what we tend to do, excuse me, is have a kind of resilience pathway. So even if there's a drawdown, a la 2022, for example, Q1 this year, 2025, unless there's a reason to sell that position or go defensive, unless we have genuine intellectual insight into that, we will manage through that.
Yeah.
Hence the reason, as you well know, Manish, yourself, in early April, first week of April to now, Nasdaq is up 50%. After facing, I don't know what it was, 20%, I'm sure you know more, 30% drawdown in Q1. If one was trying to time that, they perhaps would have drawn that down, gone under with the US. I'm going to explore that in a second as well. So what's your views on this kind of high conviction, no leverage, patient capital, investing the best ideas? As you well know, globally, there are over 100,000 funds, for example, listed everywhere, UK, Europe, US, whatever. So many fund managers, fund houses. We only believe there's probably 10 or 12 fund houses that are very, very good. Yours being one of them. I hasten to add to that, Manish. So what's your views on that kind of investment philosophy that underpins what we do at Binary Capital across all of our investment strategies in the main? High conviction, low turnover, being patient. If things change, clearly one will change. We went more into absolute return or liquid alternatives in Q1, late Q1, early Q2, 2022. Otherwise, we don't change. We have a very low turnover threshold, maybe 10% at best. And then we want to manage through that and manage that timing as well, Manish. What's your views on that kind of philosophical view of managing money for pension funds, for pensioners, ISA money, for IFAs in the UK space, which is where we face into as a firm?
So I would say, Saftar, that's the way to do it. You have to have the patience and you have to have long-term view. Mm-hmm. And yesterday, Paul Tudor Jones was on CNBC, day before yesterday. Yeah. He talked about that this is 1999. Yeah. Go back and see what he said on May the 6th. And I was watching that. And he said that, and this was when S&P was at, I believe, 5,600 or something. Okay. And he said that there's going to be a new low in the market, even if Trump cuts the tariff by 50%. Wow. He said that. It's on record. Yeah. He was completely wrong. Yeah. I have so much respect for this guy because he's a genius. Sure. I watched his, you should go and check his documentary that he made in 1987 where he walks around the trading floor and he's reading from a paper, and like 1987. So he's a legend.
Yeah. Great crash.
The good thing about our market, what I like about investment, is that what you did last year doesn't matter.
True.
You have to keep performing going forward.
Yeah.
But a lot of people get caught in headlines. So when you see some star on television, you just start believing. Mm-hmm. You know? Mm-hmm. Most of the time it is your own biases, because you start looking for confirming biases. So if you're a bear, you will look at all the bearish story, and that is the worst thing to do, because you're just not informing yourself properly. Yeah. And the reason I highlight bear, because there's an asymmetry in the market. Bears always approach everyone like they're saviors. I'm going to save you. I'm going to protect you. People love that. Everyone wants to be saved.
Everyone to be saved.
Like psychologically, I want someone who's strong, who's going to protect me,
save me. It's like a doctor.
It is just the wrong attitude, and which is why people lose. Yeah. Because they're looking for saviors. They're not looking for people who will. So when I make a bullish thing, I come across as a salesman. I'm trying to sell you something. Everyone hates the salesman. So this is, to me, is the basis of how people get the investment wrong. Yeah. They don't want to hear positive views because, oh, this person wants something. It's like it goes much deeper at a human level, you know. And look what happens. So if the bear is right, what happened? The market went up. So you made money. So you don't care about the bear anymore. Sure. But if I'm a bull and the market went down, you care. Oh, you lost my money.
Of course.
Bear can be wrong 20 times and nobody cares. Yeah. Which is why they get away.
Sure.
Because nobody talks about their losses, nobody talks about the bad, because everyone made money, everyone is happy. People come on television, I go on television as well, but I'm just saying that nobody keeps record of what they said. unless you go and really find it
Yeah.
and make an effort to really inform yourself, you're never going to come out of these biases. We all suffer from biases.
So what you're saying, Manish, nobody knows really.
No, people. No, I'm saying that people need to know their biases.
Yeah, understand that.
And that can only happen.
Manage through that.
Yeah, that can only happen if you have a feedback mechanism in your head.
Yeah.
And I think that there are like thousands of good people. That doesn't mean you have to speak to thousands of them. You need to choose and speak to a few of them.
Yeah.
But have some sort of feedback mechanism. Don't have this happy thing, bearish view, which is what I see a lot of clients fall trap into. They don't look at what had performance happen, So what I'm saying is that we all have biases.
Got it.
That's one job I do as a portfolio manager for the last 20 years, that you need to know your biases and you remove actively. If you don't remove that, you always fall into that trap, because we are all human beings. We all have emotions and feelings, and that's what market is not science, it's art. I mean, I can put data in spreadsheet, but my decision comes from my thinking of where the positioning is, where the flow is, what central bank is going to say, what somebody else is going to say. The spreadsheet is just an extension of my brain to keep my data, right?
Yeah. That's a good point, because it's quite funny, Manish, because one of our strap lines at Binary Capital is investing is an art and science. Okay. So we kind of try and bring that kind of point across. And I completely understand what you say about biases. We all have our biases. One thing I've tried to understand from experience is, so we all have our biases. You have a bias, I have a bias. It's very hard to minimize them or completely, because we always have a bias, even when it's dark, do we go out, do we not? There's a bias towards, London, somebody might steal your phone or whatever.
Which is true. A lot of phones are getting stolen. So
so exactly.
I think that's a good bias,
So the thing is, it becomes in a feedback loop as well. I think it was Soros who called it reflexivity as well. It becomes kind of feedback, because you have a bias, I then play into that. That bias might even increase and so on as well. So it's interesting you're completely right. Psychology, again, I'm maybe touching this at the end, reading books and understanding yourself. And it doesn't have to be finance books. It could be political books. It could be biographies about politicians or others as well. Is quite important. But I want to touch on something that you touched on there, Manish, around bearish views or being a bear. Because it's something that we talk a lot about at Binary Capital. We're in the investment game. We're trying to produce quality, credible returns for clients consistently. Touch wood, we've been doing that well for the last... since inception, certainly for the last 3 years or so, more so, top percentile return. So we're very proud of that fact. At the same time, as you well know, there's a lot of noise coming down, whether it's the FT, CNBC or Bloomberg, about market valuations. Market valuations are quite expensive on most metrics, whether it's the technology valuations, the Mag 7, the EI boom of themes or exuberance that we're now seeing. Even the Bank of England, I think it was the other day, made comment on it. Some Altman's made comment on that as well. I'm sure you have, I've been through the .com bubble and subsequent burst 25 years ago. I want to ask you, because we're a little bit cautious in that context, albeit going back to the point about being long-term and patient capital, we want to see through that. Because we don't know when the correction, if it happens, when it comes, and how deep it will be. So how can you, going back to what you said earlier, Manish, how can you second guess a view when you don't know when it happened, if at all it happens? So I understand your view on the market view just now in terms of valuation trends, certainly the US market, and how are you positioning from a macro point of view, taking your point about the structured trades that you do as well. What's your view, notwithstanding that as well, around that? Are you more cautious than you were 6 months ago? Or are you see this more of a kind of long-term phenomena in terms of technology, which we do kind of? We think the AI theme is probably underestimated long-term, but short-term maybe overestimated. I think Bill Gates gave a very famous quote on this on the internet 20 odd years ago. Again, a view on that as well, bearishness, valuations, US, EM's done really well this year. People are getting nervous. What's going to happen in Q4 and 2026? Interest rates, will they go down? A lot of take in there, Manish, but keen to get your views. Please expand on that as well.
Yeah, so let's look at one by one. So let's address the valuation point of view.
Yeah.
Let me give you some stats. NVDA is a stock that everyone loves to hate, right?
Yeah.
Because bubble and all. NVDA's forward earnings, 12-month forward earnings multiple is 24. Costco's forward earning 12-month multiple is 40, which is an expensive stock. Costco is not going to grow the sales or earnings by 60%, which is what NVDA is doing. So when you put things in context of where things are, it doesn't look expensive. To me, it doesn't look expensive.
Yeah.
Because at index level, if you take out 8 to 10 stocks which are doing really well, then most of the other stocks, so if you create two index of S&P 490 and S&P 10, you would have a completely different discussion, right? Yeah. So to me, it's not expensive. Now, let's address the AI and the tech part. We are going through a substantial and a massive big change in society. I will put it down to the sort of things we saw in Industrial Revolution.com. It has happened through history. Mm-hmm. So I love history. I think that you learn more from history than anything else. If you go back and look at railroads, when railroads came in 1850 after Industrial Revolution, you had fortunes were made and fortunes were lost.
Yeah.
Everything becomes a bubble at some stage. But you will make money and you will lose money if you're not careful. Then you had the auto company in 1910 with Ford and everything else. Yeah. How many people told Henry Ford that nobody's going to drive the car? Yeah. People will still go in carriages. Do we see carriages? We don't. So what I'm saying is that there will always be skeptics. That's how the world evolves. So you're going through an evolutionary change. And then you had the the steel companies, mm-hmm. Carnegie and everyone made money, and then people lost money. Then you had consumer company, Pepsi-Cola and Coca-Cola. If you own stock of Domino's Pizza, you made tons of money over the last 20 years, right?
Sure.
So you go through cycles. Those things don't end after 12 months or 24 months. So I think that we are at early stage of something big happening.
Really?
Yeah.
You think this is something very substantive?
Yeah, and I'll come to .com because a lot of people always draw comparison to .com.
Yeah.
So when .com happened, and of course you had Cisco and all other shares coming through, people. The internet was not even developed. The reason you had bubble and everything fell, and then Amazons of this world came up, because you had the change coming and the world was not ready for it. Mm-hmm. You still had a dial-up. Remember those dial-up from AOL dial-up, and all these things? Cool, you cannot deliver internet, cannot deliver e-commerce. So you had Amazon. Amazon was supposed to only sell books. Look what they're doing now. It took them time. So I think that NVIDIA is not just a semiconductor company. To me, it's the electricity. To me, it's the basic infrastructure.
Electricity.
Yeah,
right. Okay.
Basic infrastructure which is going to go throughout world, and you will have application. Now, what are we doing with AI? We already work on technology. It's just making it better and making it productive.
You know, worried, Manish, around the whole kind of vendor financing.
No, I'm not. And
questioning that's happening.
I'll come to that.
Yeah. Please.
If you are NVIDIA, you can do two things.
Yeah.
You can start doing stock buyback, which I hate unless that's the best thing to do. NVIDIA. So Jensen Huang has two options now. He's generating so much of money. Cash flow is coming out of years. The company is making so much of money. You can either start buying your stock back, which I believe is not the best option if you see growth. Yeah. Or you start taking equity stake in companies of the future. So what did NVIDIA do? They took a stake in OpenAI. Yeah. Yes, they are funding OpenAI. OpenAI needs the money today to get all the compute that they need. To me, the risk is going to come from energy side. And this is where one has to be cautious. That the world needs a lot of compute, but you need a lot of energy to deliver this compute. And I don't think that we are prepared for that. And that's where you're going to see, if you start putting a nuclear plant today, it's not going to produce electricity until 7 years from now, right? So I think on energy side, we are not ready. We've run this whole green agenda, as you know, and it has backfired for many countries in Europe. And I think at some point you will see people going back to, I'm not saying, I believe in climate change. I'm not a denier, but I'm just saying that you need energy. I'm skeptic because I think first you need energy security for people who are here today. Yeah. And not worry about what's in 100 years' time. You need energy security now. Yeah. So, but if these companies do need compute, and for that you need energy, somebody has to provide that energy. So you will have some questions to answer. But fundamentally, I think we are on a path which is going to change the world, because that's how evolution works. And I gave you example of railroad to cars, to consumer company, to internet. You just keep moving forward. And
so a bit like what we are seeing at Binary Capital, Manish, you're saying you're kind of cautiously bullish long term, despite some of these kind of headier valuation concerns that we see daily now in the headlines.
I don't do any mid-cap and small-cap stock. That's one reason, because that's where the risks lie.
So you do large and mega cap?
Yeah, that's where risks lie, where you don't have revenue and your stock is going up 20-30% every day. No, that's where your problems are going to start. Well, probably you can make a lot more money on that than doing NVIDIA, but you will also run a lot of risk. True. So this is where the idea of managing your risk comes into play. Mm-hmm. Personally, on my NVIDIA position, I'm up 10x. And I learned my lesson.
You're up 10x.
Yeah, on my personal investment, in my personal investment. Yeah.
Okay, tell us more. Tell us more.
Because why I'm saying that, because I saw what happened with Tesla. I saw what happened with Bitcoin and everything, which I completely missed out on because I was skeptic. And the reason I'm telling you, because we all have biases. We take time to understand.
Indeed.
I was told by my friend Kelly, who worked at IBM data center or data storage. She did something on data.
Yeah.
To buy Bitcoin when it was $400, and I didn't believe her. I didn't want to believe because I was still driven by my model and equity and all. But that's what happens in the world, which is why you got to be very open.
So you missed out on a $400 Bitcoin trade.
Exactly. So so I learned from that.
Yeah, of course.
Because I told you right at inception.
Yeah.
We all have biases. You have to have feedback. You have to learn.
Yeah.
Then on Tesla, I missed out a bit, but on NVDA, I caught it because I listened to what Jensen was saying. I saw the revenue come through.
Early.
I saw the sales come through. But there's always skeptics. The stock has been beaten down every time.
Yeah.
And so if you go and look at NVIDIA, and that stock has gone through 50% chop few times. And it's very tempting to sell a position once you've made 100% gain because you think, oh, it can't get better.
Yeah.
And that's the mistake everyone makes. Because if you have something which is evolutionary and fundamentally changing the world, it is going to go 10x, 50x, 100x. So you don't just, you sell because the story has changed. You sell because the philosophy of that company has changed.
What do you feel, Manish, around what we were talking about this in the office yesterday amongst ourselves about quantum computing? Again, that's getting its own kind of scale up as well. P Sigma, there's a few other companies out there that, even in the last 2-3 months, they've been.
So I don't have a very strong view on that.
Nobel Prize for Science was won by quantum computing experts a couple of days ago as well.
So I think that research is very powerful, and there's one thing good about human being is we are survivors, and we bring out change and we do things that is required.
Yeah.
Which is why we are human being, and we can cook and we can do other things.
Yeah.
So I am an eternally believer in humanity and how humanity comes with solutions to everything. But there's certain things. So on computing, quantum computing, I haven't done any research, so I don't have very strong views on that because I think that the AI, semiconductor, and the chip business is so big, and you're going to see so many things happen that this alone is going to drive things for next 2 or 3 years. Of course, you will have some companies that are going to go bust. It happened in .com, in railroad. Not all stocks are going to go up. You have to I look for profitable companies. I look for sales coming through, earnings are coming through. It should have free cash flow. Because if you are a business that is generating cash, you don't need funding. You don't need to go to debt market. You don't need anyone's funding. Why are the the hyperscalers committing so much to buying chips and all? Because it's their own cash flow.
Yeah.
They're not borrowing from the market.
Yeah.
This is not 1999 where you're borrowing anything from market, or just basing things based on just prayer and hope and something. These are real cash flow coming.
So if you see a correction, obviously the quantum of that correction we don't know. It could be 20%, it could be 30%. You'd be happy to invest through that?
For companies like NVIDIA, I'm 100% committed that they will do a good job.
So you invested in Q1.
Yeah, they have so much advantage.
Even during the drawdown of Q1 and then the subsequent
because
doubling.
they have just so much advantage.
Yeah.
NVIDIA is only now getting into the service business where they're helping companies build their own cloud. They were just selling chips. Think about Apple when they were just selling machines like phone or anything, but they didn't have the app store from where the service revenue is being generated. NVIDIA is entering that phase because companies cannot build their own cloud. They had to borrow cloud business from AWS. So that now they're helping them build cloud and giving them the compute. So I think next phase of service is happening. The reason I'm talking about NVIDIA because there are only few stocks I like, and this is one of the big one where they have a massive advantage over everyone else. But even small companies that are cleaning up data, which is going to be made available to large language model, even they will be powerful because there's a lot of data which is not in a shape that it can be fed to an LLM machine to draw conclusion. It could be like somebody running a car business or laundry business or whatever. Those data are on paper and pencil that needs to be turned into a format before it feeds to an LLM and then creates something out of it.
Another thing we do, I take your point about the way you manage risk in terms of for your clients, Manish. So it's very interesting. One thing we do at Binary Capital is where for many clients, we have what's called like an endowment model of investing, based on Swinson's, Lee Swinson's theory or whatever, where we have fixed income, equities, perhaps in a 60-40 less fixed income, and genuine liquid alternatives. that could be UCITS funds.
So what percentage would be your liquid
to give you an example,
alternatives? Yeah.
we're quite bullish on this. So again, going back to the point about being high conviction, we would have, for example, 60-40, 60% equities, 20% fixed income.
And this would be your
and 20%,
balanced portfolio?
That would be a balance. Liquid,
so 60 equity, 20?
Fixed income, medium to short dated, fairly cautious. And then liquid alternatives to manage that downside protection, some of the stuff that you've talked about, as well as the upside growth, assuming markets are volatile or we come through some corrections. Again, interested to explore that from you. Hedge funds, so many products out there. What's good about that? What's not perhaps good about that as well? Some of them come with high fees. There's obviously liquidity issues there as well. Hence the reason we only look for generally liquid alternatives in that space for our clients as well, because we have to obviously have them on different platforms, and we have a duty in terms of liquidity traction for our clients as well. Again, is this something you come across, you thought about, you could have read up on as well?
So what we do, we largely do equity and bonds. So we don't do much alternatives.
Yeah.
And I'm sure there are great alternative firms, who do a good job. But I just believe that you can get most of your returns from equity and bond structure. Even for things that I do on equity, I can create a bond-like payout. Because ultimately, what we are really looking at is what is the return that you're looking at and with what level of predictability. Right, in the sense, right? And I'm a strong believer in transparency. So I really need to know what's in my book.
Yeah.
So when I create a note or structure, I know exactly what I have. It is liquid, it is large cap, I know the risk. My problem with alternatives is that, unless I've done research on that, is that if it is not transparent, I'm not buying it. Look at what's happening like in recent news, right, with First Brands, Look at them. This is just a car leasing or car financing company.
Indeed.
Where did it go wrong? You would say that, it's a car financing company. What can go wrong?
Indeed.
But when you have layers, so somebody's originating risk, somebody's taking risk, and you have layers in between, that's when the problem starts.
Do you think that could be something systematic?
No,
that's a one-off?
I think that you will have more losses because they were running a really big book. So it can't be just UBS is on hook for $500 million, as the FT calls it, and I think today it came out that Jefferies
has got a large exposure there as well.
So I don't think it's just $1 billion. Probably it'll be a few billions.
Right.
But if it is coming from private fund side, we are not concerned.
Do you not think that's another top of the market?
No, because
sign?
it's not.
See, it's not.
No, I think that it is sign of excess happening in the market because there's liquidity. Correct.
Yeah.
But unlike in the past crises when you had, especially look at the GFC in 2008.
Yeah.
These bonds had been sold to retail investors. Private credit is not being sold to retail investors.
Mm-hmm.
They're being sold to experienced family offices or other things. So you're not seeing the losses really come.
Yeah.
Any loss is big loss. But to me, $1 billion, $10 billion is not big in the overall context.
Yeah.
It's a problem for these houses or these private funds and for banks that have lent money to them. I'm sure some big banks' name are going to come out because somebody was holding... UBS has, and Credit Suisse obviously was not available, so UBS keeping the Swiss tradition alive of buying these things.
Yeah.
So what I'm saying is that it is not as big a thing to cause a systemic thing. The reason systemic happened in 2008 because that was really a mom and pop mortgage which was being sold to everyone, and the leverage in the whole system was very big. So I don't think we are heading into that anytime soon.
I know you have a strong interest in politics. And views in politics as well. So I want to explore that a little bit as well. The reason being, obviously, as investors, as global investors, one has to take a political view as well, especially now with what's going on. And also, I want to explore this in a bit more detail. And again, Manish, be as provocative, as open as you wish to be around this kind of polarization that we're seeing, the left and the right, the whole immigration debate, where it's Europe into the UK and clearly with America and Mexico and Latin America as well, and that kind of split that we've seen. As you know, Reform now are 30+% in the poll. All things being equal, Nigel Farage will maybe hold the balance of power or become powerful in the next election, and whenever that is in 4 years' time. So a long time to go for things to change, but still, even now we're seeing politicians pivoting to that agenda somewhat, whether it's the Conservatives or Labour and so on. again, it's got factors to play as investors. How does that nationalism, local nationalism, migration, or lack of perhaps inflation trends, and the kind of political superpowers coming or not coming together, the US, China, and even now with the Middle East, we've got al-Sharaa becoming now best friends with the US now, when he was previously an Al-Qaeda operative in prison or whatever, or seeking to be chased by the US and so on. So again, a lot of points there, Manish, but keen to get your views on that. And how do you think that filters down to the investment level for investors, a balanced portfolio, for example, for Mrs. Smith in her SIP, in Manchester?
So I would say that politics is important, but not all important.
Yeah.
But it takes a huge amount of bandwidth in terms of how it happens. You are seeing a social change, right? So to me, it's just lack of leadership.
Yeah.
We just do not have strong leaders who can deal with the crisis. Or you have Angela Merkel saying that the reason Russia-Ukraine war happened because the Baltic nations and Poland didn't want to acquiesce or didn't want to do a deal with Russia. How come you are a leader of Germany and you're saying that you are being driven by Baltic nations and Poland?
Mm-hmm. Yeah.
Sign of weak leader, right?
Yeah,
and for her to say that.
Germany is such a large
In this country, we've had 14 years of conservative government who have governed like Labour.
Yeah.
They cannot blame Labour for the problems we have today. Because had they done their job, you wouldn't have a Labour government to start with. So same thing happened in the US. The Democrats did a very bad job. So you got Mr. Trump. You may like him or not like him, but the response from the people that we don't believe in current set of leadership and any of their policies. So I think that you have seen that globally in the Western world, at least in the Western world, that people have rejected status quo. People have rejected, weak leaders, and they have no clue. And largely what you have seen is a politics of pandering. So you saw with climate change, you saw with everything, and we saw the investment world where ESG became one of the biggest things.
Big
and then as soon as you saw the performance start suffering because, it was not the right investment to do, then people have stopped talking of. Nobody mentions ESG anymore from what I see, but they were like consultants and conferences, and day in, day out, things were happening. If you take your eyes away from what
you think that ESG was all like a scam, then really?
No, see, I don't think it's a scam. Salesmen will always sell what people want to buy. Right? So I don't think. That's their job to sell. It's also to the gullible buyer.
Yeah,
it's to the buyer. So I think that if you talk in terms of politics in this country, people who bought into what Prime Minister Boris Johnson or whoever said and he didn't deliver, it's on to them. It's on to me. People like who voted and they didn't get that,
of
right?
course.
But then people learn from that. So the Tories cannot come back and offer the same thing and people are going to buy it, which is exactly why you have reform now. When they don't deliver, then they will be out as well. So you are seeing that social change happening. So partly it's that, and big aspect is economic, because you've had a generational shift where the pensioners are doing much better than people who are getting on the job ladder.
Sure.
It's a shame that nobody calls it out.
Yeah.
We have triple lock, we have all these generous pensions.
Yeah.
It's not even means tested.
Yeah.
There's so many things in this country which are not means tested, which is just given away.
Yeah.
And there's so many scandals coming out and going on. So, but why does that happen? Because you have weak leaders. You have weak leaders across politics, weak leaders in bureaucracy, and a weak leadership in media who just seems to talk about things which just makes them get clicks. And so it's a social thing.
Yeah.
And the response to it always when people strike back and say that we don't want to hear
So you're saying Trump is good because he's a strong leader?
See, I'm not saying he's good or bad. I'm just saying he's a response to what the society created, and therefore he came here. Look, the kind of press conference he had yesterday with Canadian President Mark Carney.
Yeah.
It was so jovial and so good.
Yeah,
this is coming from a guy who couldn't stand each other.
Yeah.
3 months ago.
Yeah.
Who ran on a campaign in Canada to take on Trump.
That's true.
Which led to Pierre Poilievre not becoming prime minister, who was a front runner.
Yeah.
And now he's sitting down with Trump, taking tariffs up and doing a deal.
Yeah, best
so
friends.
Trump can't be a bad man if you're doing a deal with him.
Yeah.
So what I'm saying, you have to look beyond the personality and look at what your country needs, what your people need. And if that sort of politics, if you do, then you will be successful as a party. Well, today we had the Tory party conference and we have Kemi Badenoch saying she's going to get rid of the stamp duty.
That's right.
On the prime property. This should have been done 10 years ago.
Yeah. You think that might make a difference?
So do you believe her?
Yeah.
Because
yeah.
Is it just a gaslighting again? Because they could have done this last 14 years.
Yeah.
They haven't done that. Or is a desperate attempt to come back and be relevant. That's for people to judge. But to me, like, you cannot be a conservative and govern like Labour. And I said this 2 years ago when I was speaking at a conference or something. I said that just because the Tories conservative govern like Labour, Labour will govern like Conservatives. I.e., they'll have to cut taxes, cut spending, and which might come in the budget, and because it's something they will get rid of triple lock because it's what country needs.
It's something that we're trying to understand, Manish, around, certainly the US, for example, Trump or US Inc. is looking to buy companies or taking stakes in companies, Intel's being a good example. And more recently, again, I was talking to my colleagues around the US trying to really capture this kind of AI technology IP, so China doesn't have it, or any other nation doesn't have it otherwise, because it's so crucial to the nation state as defense is to the US and so on as well. So they will do whatever it takes to where it's not selling NVIDIA chips to China, tariff controls, trying to get inward investment into the US and trying to keep the IP, the jobs, the experts in that. But at the same time, he's trying to cut down on visas, HB1 visas and so on as well. Where do you stand on that kind of policy making, again, from an investment point of view, from just a political, philosophical point of view as well, what they're trying to do?
Sure. So you always have to cut through the noise.
Yeah.
So if you look at the whole H1B thing that Trump has done, the big companies, and this was on record from Jensen Huang yesterday, that they will continue to sponsor candidates and bear the cost of the visa. I think the people who have to move, the people who should move for the right reason, they will continue to move.
Yeah.
I don't see that's going to be hindered. Was there a case of a lot of people moving just for economic reason and not contributing and taking more from the state? Yes. And we have in this country, the stats are very clear. The stats are very clear in the US. So Trump is not entirely wrong, but he's not entirely right either. He cannot just stop everything because that is going to hurt businesses, or people are going to move. Then people are going to move to Canada or to UK, and the governments are going to support those moves because it is being driven from economic or business demand. So there's always a difference between the rhetoric and the big thing that people talk about and what happens eventually, which is why Trump got that name of taco. Trump
Trump
chickens out because, and I think it's a good thing. I have a problem with people who are ideological, who can't change their mind. I love people who can change their mind, who can be persuaded to change their mind based on evidence. So Trump, with all his failings, he is not an ideologue. He has no shame in saying something yesterday and something opposite today, if it believes that that is going to help the market or help the economy. In my opinion, you can never underestimate the US because it's not just about politics. US has the most innovative company. They have the capital, and it's US dollar. They literally have to print money to fund anything that they want. That's a powerful thing because when you can raise
capital. You're in the
capital,
kind of US exceptionalism camp.
To me, absolutely. I'm dollar overweight. I'm US overweight, and I'm not changing that. Because you always see very short-term moves about people talk. You're going to move money to Europe. The stats doesn't bear it.
This year.
Very small number initially, but the stat doesn't bear it. You still have more money.
What about gold? Gold's over 4,000 now. Gold's becoming a very popular.
I don't have any gold position apart from the jewelry that my wife has, or my mom has, or my sister has. So to me, gold is a jewelry. It's not a currency. It's a very unpopular thing to say given where gold is today at 4,000. But I'm not a buyer of gold. To me, gold is the ultimate insurance. If something was to go wrong, gold is going to help you.
So why has it gone up? Why has it gone up so much?
Central banks are buying, and of course it has become a discussion. I think it'll go even more, even though I'm not a buyer, because when these things happen, there's always a last stage of euphoria where more and more people get in. And that's where you make another 30-40%. But you remember what Soros said, that, or even Druckenmiller, who is a protege of Soros. When you see a bubble, you get in there first. Don't get in there last.
True.
And then
it's hard getting out. It's hard getting out.
Well, and that's what your calculation and timing has to work for you.
True.
But both Soros and Druckenmiller, whenever they see something, they always trade first, ask question later. I'm not recommending this to the listeners because it's up to you what risk you want to take.
I got it.
But what I'm saying is that, there's always a phenomena. So gold could go ahead. Let me give you a scenario. We live in a nominal world, right? The world went off gold standard in 1974 under Nixon. We are never going back to gold standard, no matter what people say. For a country to have economic might, it's not GDP per capita, because then Norway would be the strongest country. You have to have the size. So it's the size of your country, consumer base and all, a strong military, to enforce contract. You can't enforce contract on me unless you have a strong military. It's like investing is common sense. It's driven by what governs the world and who are the powerful people, how it works. And this is where you have to understand that US is the strong power. They have the strong military. They have dollar that everyone wants. US could cut dollar funding to the world. What is the world going to do? Are they going to agree between them which currency they're going to use next?
The default currency, yeah, interesting.
It's a no-brainer. So to me, I'm happy to hold my fiat dollar currency and let people hold gold and do what they have to do. But for me, gold is jewelry, not a currency.
I'm conscious I've asked a lot of questions, Manish, so feel free to ask me questions as well.
So I have a question. So for me, it always comes down to how do you size your trades? Because I always think that, I say this too often, is that it's not about, I always say that anybody can copy my trade, but they can't copy my conviction.
Sure.
And that's how investing is about. I can tell you buy gold, but then you have to navigate through.
Of course.
And that's where the investing and experience of going through cycles in the comes through. Yeah. So I don't invest in funds, but when you see fund, like, how do you size your portfolio? Because this is something that I like to ask everyone, because everyone has their way of dealing with.
Yeah.
You know, what percentage do you go in as your first trade? What happens when it's down by 10, 15? And then what do you do? So to me, the sizing is the most interesting question.
Yeah, no, it's a fair question. And the way we think of that, Manish, is kind of twofold or two or threefold. Firstly, we look at the country allocation or the thematic allocation. For example, again, you might have a view on this, the ACWI World Index, the US is about 65% of that index. Our typical portfolio on 100% equity would be about 52%, as an example, our passive growth or passive adventurous portfolio. So we're underweight the US, okay, first of all, but not relative to our peer groups, we're probably overweight by 10 percentage points, 40, 50, index 65. The way we size it is this, going back to the point I said at the start of this conversation, is we are also high conviction. We think that's the only way to invest. Otherwise, you might as well go to Vanguard, BlackRock, and buy a passive, multi-asset passive instrument for a very low price point.
Yeah.
You know, they're great at doing that. They manage trillions of dollars, and they're great. They're amazing and professionals there. So the way we size that is, we want to be conviction led. To give you an example, in the US, passive is dead easy. You buy the best passive instrument or instruments out there, maybe hedge the currency or half hedge it, which we tend to do. In an active book, as I said, there's so many fund choices out there.
What percentage is active book when you?
When I say active, as an active model portfolio. An active model portfolio. Say we have 50% of that in equities, for example. How do I size that amongst US, EM, whatever? Obviously, it'll be quite a lot will be in the US relative to that 50% percentage. What we then do is this. We don't believe, maybe a bit like you, Manish, we don't believe, a lot of active fund managers, we don't believe deserve capital, okay? They're closet indexation, they underperform, the fees are high, there's not liquidity, there's not transparency, going back to your point about lack of transparency on the portfolio. Yeah. So we don't want to invest in them. So we believe with that, say 100,000 or so IMs out there globally, probably maybe 100 deserve capital, and we want to invest in the top 10 or top 12, okay? Whether that's somebody in Edinburgh, London, or New York, or so on. And then we will actively give a high conviction position to that. Typically, it will be, for example, say we allocate 15% to EM. I'm happy to give all of that to one manager, okay? Provided we have conviction on their view, because we want them to be high conviction as well. We don't want them to be indexation-like or closet indexation. So I'm happy to give it to one manager or two managers at best. I don't want to give it to 5 managers, because if you look at it from a diversification point of view, again, you end up with a closet indexation or an index type strategy, and clients don't pay us for that. So we are very high conviction. And the way we size that is we don't typically go in at a low percentage point and then ramp it up as the price goes up. We go in at that price point right away because we're buying the fund. We have conviction in that allocation. Yeah. We want to stay with that allocation. Some funds we've held since inception because we've had that conviction from day one, despite what happened during the COVID time or 2022. And so far, touch wood, as you well know, I can talk to you all evening about this, Manish. As you say yourself, we are humble to the markets. The markets tell us where we're right or wrong every day, every month, every quarter, every year. And touch wood, the proof has been in validation of our numbers, net of fees or gross of fees, whatever one wants to look at it, against a peer group or in isolation. Hence the reason, touch wood, we are doing well as a firm. But as you well said as well, we're not looking back. October the 8th, now I'm speaking to you, it's about the future.
Correct.
It's about the next quarter, next year. The past is the past. It's not going to repeat. We don't know what's going to be produced. So we're always trying to, almost like a blank sheet of paper, how are we going to produce returns, guys, this quarter, next year? Let's try and think out the box a bit more. We're looking at, for example, more EM next year, perhaps as well. We're looking at maybe some more value positions just to offset maybe some of the riskier stuff that's happening in US valuation. So that's the way we kind of, it's a long way of saying it. We're just very high conviction, Manish, around that. And we're not scared of that because we are independent. We're whole of market. We're independent. We don't answer to anyone but ourselves and our clients or potential clients. And we want to be like that at all times. We don't want to scale to a size where we have to have hierarchy of investment positions, portfolios, teams, where you just dilute the decision making and you become an index type manager. As you well know, I'm sure you've got a view on this, there's a lot of active guys out there, but are they really active? If you look under their business model or under their strategy, even some of the active guys are now producing active ETFs. Or passive products, and you're thinking, why are you doing a passive product when you're meant to be an active player and you've got 300 billion on your active booth? So you're giving up on your active side. You don't believe in it anymore. So there's a lot happening in that space. So we think there's a market for us, clearly, and there's more so based on what I've just said as well, Manish. Hopefully that kind of answers that.
Yeah.
Somewhat.
I do agree with you because, and this is where I would say that investors or clients, they have to look at what's happening to their portfolio.
Yeah.
And sometimes people just look at NAV, they don't look at any attribution.
Yeah.
And it's not a difficult exercise. It's just that, you have to look at your portfolio, don't look at just the money in that, but also look at, what has happened to the fund and how your allocation has changed over time. And the clients are very busy people and they have made their money not in investing, but in a real business.
Yeah.
But I always say that, even though a lot of these things are relationship driven, you have to take some time to see what your investment advisor or investment person is doing, for you just have a sense of sanity check that that the person who you have advising you is doing the right job. I'm not saying people should go and change the investment advisor, but it's like they should have I'm a big fan of feedback mechanism because it just makes you a better investor and better person.
I'm conscious that we need to wrap up soon because it's been gone fast. I mean, this conversation has been fascinating as ever, Manish. It always goes so fast with you. I want you to give us one investment tip that we should all take away as investors or as even human beings, and tell us what you're reading now as well. Give us a tip on what you're reading, what's interesting for you. So
one thing I always say that, always fall in love with the process, not the outcome.
Yeah.
Because if you fall in love with outcome, you become anxious. You think in terms of beating something, achieving something. But every day you should wake up, you should love what you do. And to me, that's process. So when I'm in the morning, I'm reading my paper, something I'm not looking at my stock should go up 20%.
Yeah.
I really want to learn about what's happened in the world. So I think if you fall in love with process, anxiety goes away. If you're always outcome driven, anxiety goes. Yeah, goes because you've ignored the process.
Philosophy,
The outcome will naturally come if you have a process.
Yeah.
If you don't have a process, there is no outcome, no matter how much you stress about it. So I always say that even for people who are starting on a career, mid-career, wherever, I think that it's important to have a process on which. And I just love to read. I mean, I have two children, 6 and 9, and whenever somebody asks what will they do when they grow up, I say, I just want them to know the maths and know the history.
Yeah.
Because maths for everything rational, history for everything irrational. You just need to know. Because if you know these two, then of course you should do languages. I don't mean to say anything less of that. But once you understand the number and history, and in the continuum where you are and people have come before you, you understand the world because it's all the same people all the time making the same mistakes. So why not learn from people who came in the past and learn from their mistakes? So to me, these things are very personal because even though I did engineering and maths, but I spend more time reading history than anything else. And I go and I do event-based research. So I will pick a topic. Let's say you talk about gold. I'll pick a topic, gold, start searching, when gold price went up, what happened? In that context, if you go and search for Hunt Brothers and what happened in 1920s or 30s where they took the silver market and the government came hard on them and bankrupted them basically. So they made a lot of money and they lost everything.
That's right.
So you need to understand that government is very powerful.
Sure.
So if you're going against somebody's big interest, you can make money, but you can't keep it. So those real things to me is very, very vital.
Finally, Manish, I just want to say thank you
for
being our guest at Binary Capital's podcast series. We plan to have a series of this going forward. You have been an honor to be our inaugural guest.
My pleasure.
May you come back next year when we can talk further on these views and more. Really value your time, your advice, your knowledge and experience as well, Manish. Thank you for your time.
Thank you
so much.